You avoided debt so well that your file came back empty. You never missed a payment. You never carried a balance. You never defaulted because you never borrowed in the first place. You use a debit card, pay with cash, and feel proud that nobody owns a piece of your future. But when a landlord, a dealer, or a mortgage underwriter opens your file, they do not see discipline. They see the invisible file, no record thick enough to price approve or trust quickly. According to a CFPB analysis, roughly 26 million U.S. adults were credit invisible, and another 19 million had files too thin or too stale to score. This video is less about credit cards themselves and more about what happens when your financial life cannot be read. We will move through 5 stages: no score, apartment screening, auto loan pricing, secured credit tools, and finally credit as an access score. Start with the invisible file. Stage 1. No card, no debt, no score. Your invisible file begins with $0, credit limit $0, reported debt, and 0 score. A credit card offer comes in the mail. You stand over the trash can, tear it once, then cut through the plastic-looking insert with scissors. The issuer promised 0% for 12 months. You see the trap before it opens. Interest, fees, points that make spending feel intelligent. You drop the pieces into the trash and feel clean. Rent leaves your checking account through debit. Groceries come off debit. Your phone was bought outright. Your used laptop was paid in cash. You keep $2,800 in checking and $400 as emergency cash. Not enough to feel rich, but enough to feel like nobody can call you and demand payment. On the surface, this looks disciplined. Underneath, very little is being reported. Your debit card does not report restraint. Your cash purchase does not report patience. Your on-time rent does not automatically become credit history unless it is reported through the right channel. The credit bureaus do not see the offer you rejected. They do not see the balance you never carried. They do not see the interest you never paid. FICO explains why that matters. Payment history makes up 35% of a FICO score, amounts owed 30% length of credit, history 15% new credit, 10%, and credit mix 10%. Your score is built from what appears in the file. Silence leaves the model with almost nothing to calculate. You avoided debt successfully. You also avoided leaving evidence behind. At this stage, your financial life can be clean while remaining unreadable. Stage 2, the apartment credit check. Your rent target is $1,623 a month, but your invisible file still says almost nothing. You find the apartment on a Tuesday afternoon. Not luxury, just better, more light, shorter commute, washer and dryer in the unit, a grocery store you can walk to. Rent is $1,623 a month. The application fee is $55. The security deposit is another $1,623. The property manager walks you through the unit and talks like this is simple. Submit the application, upload pay stubs, authorize screening. You do all 3 before dinner. You have income. You have savings. You have never paid rent late. The next day, the tone changes. The landlord does not say you are broke. The screening company does not say you are reckless. The property manager uses cleaner language. The file is thin. They need a cosigner or a larger deposit or more rent upfront. Tenant screening reports often include credit history, rental payment data, civil records, criminal records, credit scores, and proprietary risk scores. The CFPB has warned that these reports can become central to rental decisions. Rental screening tools also make credit checks routine enough that many applicants never reach the tell me your story stage. Normal move-in money was already $3,301 first month deposit application fee. Now, the safer version of you costs more. Add another month of deposit and the number rises to $4,924 before utilities, movers, or a couch. You try to explain. You do not use credit cards because you hate debt. You pay for things when you have the money. The property manager sounds sympathetic, but the policy does not change. Your invisible file became a problem the moment someone else needed fast proof. The apartment was available, just not on the same terms for your file. This is where credit stops feeling like finance and starts feeling like permission. Stage 3, thin file expensive auto loan. Your file is thin, so the car is cheap, but the money is expensive. You walk into a used car dealership because the bus schedule no longer fits your life. You are not looking for status. You are looking for a used Honda Civic with clean tires, working brakes, and a price that does not make you feel stupid. The sticker says $14,500. You have $1,500 down. The salesman nods like this should be easy and walks you to the finance desk. The finance manager asks for your social security number, your income, your address, your employer. Then he clicks Submit. You wait beside a printer that keeps waking up and going quiet. Then he comes back. Approved, but approved at 21.85% APR. According to Bankrate's summary of Experian's state of the automotive finance market, data used, car rates range from 7.70% for super prime borrowers to 21.85% for deep subprime borrowers, with prime used car borrowers around 9.98%. Edmunds also reported that the average new vehicle APR was 6.8% in Q4 2024, a reminder that the headline average and the rate handed to a risky or unreadable file can live in different worlds. The loan is 60 months. The payment is about $399 a month. Total paid about $23,954. Interest about $9,454. You stare at the paper because the car did not look like a $24,000 car when you touched the steering wheel. Now picture the same Civic with a thicker file. Same price, $14,500. Same down payment, $1,500. Same term, 60 months. But at 9.98% APR, the payment is about $308 a month. Total paid about $18,476. Interest about $3,976. The difference is roughly $5,478. Same car, same job, same income, same person, different file. The finance manager skips the speech about responsibility. The lender simply prices uncertainty. Same Civic, different price. The vehicle did not change. Your unreadability did the work. At this level, credit changes the price tag on your options rather than judging your character. This is not the part where you become obsessed with credit. You do not need 12 cards, travel hacking, or grocery points strategies. For many people, the destination is boring. One simple card, paid in full, low utilization, no late payments, no identity attached to the number. Enough credit is not maximum credit. Enough credit is enough access. Stage 4, small tools, readable record. Your first real credit tool has a $500 limit, and that is the point. You do not apply for a premium rewards card. You do not open 5 accounts. You walk into a credit union and tell the banker the truth. You do not want debt, but you do not want the invisible file controlling the next apartment, the next car, or the next underwriter. She explains the secured card. You put down a $500 deposit. The card has a $500 limit. You use it for gas and groceries, about $80 a month. If the statement closes there, utilization is 16%. Autopay is set to pay the full balance. Interest paid $0. Nothing dramatic happens. No champagne points, no airport lounge, no luxury metal card hitting a marble table. Just a small transaction, then a full payment. A record, another record, another record. Then you add a credit builder loan. The loan amount is $600. The term is 12 months. The monthly payment is about $53. Total interest might be around $40 depending on the institution. A customer service rep confirms the account reports to the bureaus. That sentence matters more than the card design. Now your file starts collecting proof. Open date, credit limit, statement balance, payment date. Paid as agreed. You borrow not for the money itself, but to create a pattern someone else can verify. VantageScore has pointed to rental and alternative payment data as one path for adding visibility. and its own research on rent data shows why on-time non-traditional payments matter for people who start with limited files. This purchase delivers a readable record more than it delivers debt. This is the first stage where credit becomes small enough to use without becoming large enough to control you. Stage 5. Credit as access score. 5 years later, your score is 740. But the real change is not the number. FICO score ranges give that number context below. 580 is poor. 580 to 669 is fair. 670 to 739 is good. 740 to 799 is very good, and 800 to 850 is exceptional. A 740 does not make you elite. It usually makes you easier to process. You are the same person. You still hate waste. You still use debit when it makes sense. You still do not carry a credit card balance. You still do not treat a lender's approval as permission to become someone you cannot afford. But your file has 5 years of payment history now. A landlord opens your application and sees active accounts, low utilization, and no late payments. The callback is shorter. Approved. An auto lender sees the same thing. You are no longer the invisible file sitting beside a price sheet. On an $18,000 car loan at 7.70% APR, the payment is about $362 a month for 60 months. Interest is about $3,744. Far from free money, just meaningfully cheaper. Then comes the mortgage conversation. Not because everyone needs to buy a house, but because mortgage underwriting shows what credit really changes. Freddie Mac's primary mortgage market survey showed the 30-year fixed rate averaged 6.85% in the final week of 2024, and its current weekly survey still shows how closely household decisions move with rate changes. With no score, you may still have a path. The underwriter may ask for rent history, utility bills, bank statements, verification letters, and months of extra documentation. Automatic rejection is not the issue. Difficulty in processing is. With a readable file, fewer people have to guess. The Federal Reserve's G.19 data put outstanding revolving consumer credit around $1.3 trillion at the end of 2024. That number is the warning label. Credit access can help you become visible, but revolving balances can also become a very expensive habit. A score does not measure your kindness. It does not measure your patience. It does not know whether you help your parents tip well or sleep calmly at night. It measures a narrow history. Accounts, open balances, reported payments, made, payments missed. A good score did not make you a better person. It made you easier to verify. This is the stage where you stop treating credit as identity and start treating it as infrastructure. Remember the trash can full of credit card offers torn in half. The discipline felt clean. The decision felt safe. The intention was right. You were avoiding interest. You were avoiding fees. You were avoiding lifestyle inflation dressed up as rewards. You were avoiding the quiet arrogance of spending money before you earn it. But the missing layer becomes visible now. What you cut up was both a trap and unintentionally a tool. At stage 1, you had 0 debt, 0 credit limit, and 0 score. At stage 5, you can still have 0 revolving balance. But now, there are 5 years of payment history sitting inside the file. That is the turn. Not from debt-free to debt-dependent, from invisible to readable. So this week, pull your credit report. The FTC says federal law gives you free credit reports from Equifax, Experian, and TransUnion, and the bureaus have permanently extended free weekly online reports through annualcreditreport.com. See whether you are invisible, thin, or inaccurate. Choose one small reporting tool if you need it. Set autopay in full. Debt is optional. Being readable is not.